Agency theory is a fundamental concept when we are talking about corporate governance, because the owners are not usually the managers of the business. So the theory of agents and owners relationship cannot be overemphasized. And whenever we want to discuss holistically about this all important theory in corporate governance, we must first of all understand what it really is. And in this video, these are the touching points we are going to equally talk about quickly: the principal and agent relationship. Then we talk about the conflict of interest. We will look at the costs of agency theory or agents managing a business on behalf of the principal. Who is the agent? Who are the principals? Those are the things we are going to learn equally. We are going to discuss the incentive system that we can use for corporate governance to be effective. We also will look at the stakeholders' interest and the shareholders' interest. We are going to talk about the limitation of agency theory. In this video, we are going to look at monitoring and control mechanism about agency theory. And we are going to talk about information asymmetry here. Then in the next video, we will pick on information asymmetry and we will talk deeply about it and how the mechanism to use to actually control information asymmetry, as we know what information asymmetry is in this video. So next we will actually major on information asymmetry. So basically this will form a comprehensive and holistic approach to discussing agency theory in modern corporate governance in business world. This is by way of welcoming you to GJAMES Associate channel. My name is Gbenga Olatunji FCA. This dashboard will not be taken away from our view throughout this tutorial. We are going to touch on everything that we could see here. So like GJAMES Associate and subscribe, share, tell a friend to tell a friend. So what really is agency theory in corporate governance, especially for those of us that are studying corporate strategic management and ethics, whether as ICAN student, ACCA UK students, ACCA US students, ICAW. What is agency theory? So basically it's a fundamental concept when we are talking about corporate governance, and basically it underpins relationship that exists or must exist between principal and agents. The principals are the owners of the organization and the agents are the managers, which we can call the executive. So the executives are to run the organization. The funders have funded the organization with the basic understanding and interest of effective monitoring. Meanwhile, the agents have the interest, which we can call self-gain and self-interest. This definitely will cause a colliding or collusion between different interests, and this will definitely take us to what we call conflict of interest. So basically conflict of interest will arise because the agents want to be taken care of, the managers will have their self-gain interest too because they are working, And equally, the owners of the business want to ensure that the business continues, make more wealth for them, and at the same time is effectively managed. Of course, without it effectively managed, we cannot talk about it being continuing in the foreseeable future time. So when we are talking about agency theory, it provides a framework basically for understanding the potential conflict of interest that may actually arise or that will arise when one party delegates a decision-making authority to another. So we are going to be exploring here the key principles of agency theory, its relevance in corporate governance, its implication for mitigating agency problems. And at the core of agency theory, it recognizes that owners of a company delegate decision-making authority to the managers, which we can call the executives, right? However, due to differing or different goals, information asymmetry, uh, a situation in which the agents actually have more information at hand than the owners of the business. That is what we call information asymmetry. And by the way, what we are looking at the dashboard, I'm taking them simultaneously in no particular order. So please stay with me so that we can follow through. So limited monitoring, conflict of interest too may arise, and when it does, the principal or there should be controls in place, mechanisms in place to ensure we forestall or restore processes or effective management. So the principal agent relationship is characterized by principal's desire for effective management of their organization and the agent's desire for personal gain and self-interest. So agency theory seeks to address these conflicts by aligning the interests of principals and the agents and minimizing agency costs. What is agency costs? Basically, agency costs is or are the costs, the expenses, the monetary implication of engaging agents to work on behalf of the principal, setting up the board of directors to monitor the executives, having good mixture of the NED, that is non-executive directors, and the executive directors. So in corporate governance, agency theory serves as a critical framework for designing mechanisms to align these interests or these conflicting interests of principal and or between principal and agents. One of the key mechanisms is to establish or the establishment of incentive systems. And this is core when we are talking about managing conflict of interest. So such as performance-based compensation, stock options, bonuses can be given to the executives to ensure that if they do this, they get being rewarded. So their self-interest and self-gain actually is or are forced to be in line or in alignment with that of organization's motive, shareholders, principals, expectation of effective governance. So this aligns the financial interests. The agency theory promotes the reduction of agency costs as much as possible and the maximization of shareholders' wealth. So monitoring cannot be overemphasized, and control mechanisms are another important aspect of agency theory in corporate governance. So when we are talking about these mechanisms, they definitely will include setting up of the board of directors, external auditors, internal controls being put in place. The board of directors, as representative of the shareholders now, has a crucial role in monitoring and overseeing the action of the top executives, which we can call and relate with as the agents. So the board must ensure that the management, that is the agent's decisions, are consistent, are in alignment with the shareholder, and provide strategic guidance. And when we are talking about strategic guidance, we really meant strategic guidance that is futuristic and aiming at achieving the best interest of the purpose the organization was set up in the first instance. Agency theory actually is fundamental, and everything about it must be uniquely and well managed. Let's take, for example, when we are talking about an agent having more information, having more knowledge of the organization more than the owner of the business, which is actually practical in corporate governance and the corporate world. So the executives now, the agents, are knowledgeable people. They are professionals in their rights. They are people with business acumen, business connection, just like the founders and the owners and the shareholders of the business. So it is very important that measures must be put in place carefully, because those that we are dealing with are actually very knowledgeable, and this can lead us to some limitation of agency theory. We've spoken about a bit of definition, the conflict of interest, the principal-agent relationship, who principal is, who agents are, agency caused by self-incentive. We are going to look at more of information asymmetry, limitation of agency theory, monitoring and control mechanism that we must put in place. Of course, the interest of the shareholders is to maximize wealth and have a comprehensive approach as I begin to round up on this topic, because I will not want this tutorial to be too long. Okay, so basically the runners, the agents, the managers of the business will definitely have more information. The agents, the executive. So this information asymmetry can lead to adverse outcome if not well managed by the principals. That is the theory of agency. It emphasizes the importance of transparency and disclosure. And for those of us that have studied the accounting aspects, especially, this is managerial aspects we are talking about in form of IFRS's International Financial Reporting Standard, and I see that it enforces and emphasizes more of disclosures, especially on the part of the steward, that is the agents, the executives. So shareholders rely on accurate and timely information which is coming from the agents. those that are well informed about their organization. So the agent must not withhold information in order for them to be accountable. And this must be enforced in form of regulatory requirements, such as from the reporting standard, from corporate governance guidelines, codes, which aim to actually ensure and enforce transparency, transparent reporting, full disclosure, and enhance the flow of information between principals and agents. Okay, so while agency theory provides valuable insights into understanding and managing agency problems in corporate governance, it's not without limitation. Now, we can talk about the complexity of human behavior, social science. Humans, we are really unpredictable because everybody has his or her mind made up, and we keep changing our mind every now and then about anything. Our outlook keeps changing, our philosophies keep changing and the like. So predictability of human behavior is very unpredictable. I hope that English makes sense. So because of that, there will be conflict of interest and we must manage it. So moreover, when we are talking about the limitation, must focus on financial performance. We must critique the financial behavior, decision making, the ethical consideration of the agents must be critiqued every now and then for the stakeholders' interests to manifest, for the shareholders' interests to manifest. Must critique how the decisions they are making affect the business as a whole, the employee, the customer, the broader society. Of course, the agents are employees too, but power pass power. Those kind of employees are really influencers. So those are the executives. So there must be a balanced approach when we are talking about the multiple dimension of corporate governance, which deals with agency theory, particularly the relationship that exists and the conflict between the interests of the executives, the managers of the business, and the owners of the business. So if I'm to conclude, I would say agency theory is a crucial framework in corporate governance, especially as it relates to our knowledge and our syllabus requirements. So it addresses challenges arising from the principal-agent relationship and ensures alignment of interests, implementing incentive systems, enhancing monitoring and control mechanism, and equally promoting transparency, because without all these mechanisms being in place, the crucial framework of agency theory will not work. So agency theory helps mitigating agency problems and improve organizations' performance. Of course, however, a comprehensive approach, which approach I've tried to take now by giving us as much as possible that we must touch on when we are talking about agency theory. A comprehensive approach to corporate governance should incorporate a broader range of shareholders' interests, recognize the complexity of human behavior, especially those of the agents, to ensure sustainable and ethical business practice. basically we had touched on in a summary form much of what we need to know and understand about agency theory in corporate governance and strategic management. Gbenga Olatunji FCA is my name from GJAMES Associate Channel. Please like, subscribe, and when you subscribe, care to click all so that you will not miss any upload. Henceforth, you will be notified. And share this video to those around you that may need it. Tell a friend to tell a friend about GJAMES Associates. We pride ourselves that we are value to life. I want to believe you add value for your time spent on this tutorial now. We are value to your businesses. So next we will deep into much of information asymmetry and how to control information asymmetry as it relates and affects agency theory in corporate governance. So we had made a definition of what agency theory is, the relationship that subsists between agents and the principal, the executives and the shareholders, the incentive system that must be in place, especially should be based on performance, executives' performance at their job, the conflict of interest that most likely will exist and how to mitigate it, the agency costs of remunerating the executive and the like for them to perform well, and monitoring mechanisms that must be put in place in form of the regulatory requirements, in form of setting up internal audit departments, external auditors reporting to the shareholders and the like. We've made mention of the stakeholder and shareholders interests. We've tried as much as possible to be comprehensive in touching everything we have to touch on this particular topic in a brief version. So information asymmetry is a bit of what we have to deal with more, and we are going to have our next episode on it from GJAMES Associate channel. Don't forget to like, comment, and subscribe to the channel.